Can you guys see my screen?
Yes.
Yes, it's good. And yeah, you're ready to go.
Cool. Yeah, so I want to talk about, so just thanks again for having me. Maurice and I have known each other for a long time. We started out together early in our career, working together in the aviation industry. So my background, I've had so many different twists and turns in my career, and I've used my curiosity to guide me. So I've used what gets me excited and gets me interested to guide me. And, between us and everyone else, the millions of people that are going to watch this recording, I started out in manufacturing. I did an internship working in at a manufacturing company, one of the bigger Fortune 500 companies. And they gave me a job offer, and it was really interesting. I thought I did really well, but I wanted to do something just a little more aligned with my interests. And the location of where that opportunity was not, as exciting of a location for me. So I almost was going to take that job offer, and then I got this opportunity to go to Cedar Rapids, Iowa at Rockwell Collins. And although that was not a big, huge city or a metropolitan, I really felt that the career opportunity was really great. And I was very gracious. They put me through my master's degree. So I would say in the beginning of the career, a learning that I had was, a lot of times there's great opportunities sometimes in locations that are not as glamorous. So, me taking that opportunity at Cedar Rapids and obviously getting to meet Maurice, Dr. Maurice, that opened up just a lot of opportunities. So a lot of times you have to think long-term, and just the short-term gains may not be may not pay as much dividends as the long-term gains when you think about opportunities. So for me, currently right now, I'm the CEO of Sutton Capital. We're a venture fund. We invest actively in early stage, late stage. We've also invested in some emerging fund managers as well. We also have an educational training program to help people get hands-on experience in venture capital and private equity as well. So we have education, we have the network, we have the community. And the things that stitched together for me was the background in technology and in finance. I think with everything, anytime you're building technology, you really need to understand the business and the business model and how you can make money and how you can scale that to a multi-billion-dollar company. And in our lifetime, I believe that we will see trillionaires. So how do you get from 0 to trillion within a short period of time? And we, the sectors that we invest in is fintech, climate change, impact, B2B SaaS. So, we're also interested in cybersecurity. Deep tech has a big umbrella over just various sectors. And then we also have a large community, co-investing allocators. I wrote one chapter in this book called The Family Office, a comprehensive guide for advisors, practitioners, and students. I wrote the chapter on venture capital. So a family office is a wealthy family. It could be, it's usually categorized by $250 million in assets. But a lot of these wealthy families, if you think about like the Walton family, or you think about the Hines family, many of these families have grown generational wealth from the businesses that they've had, and they want to make sure that that business carries on for multiple generations. A lot of times the kids that are carrying on the legacy, they want to make sure that that brand and that company and that business is still set up for success. And when they think about how they maintain that wealth, they're thinking about obviously growing the Heinz business, but they also probably want to allocate to different assets, right? Whether it's venture capital, whether it's crypto, whether it's private equity, whether it's real estate, whatever they think is going to help them maintain their wealth, with all the things that you can think of that can provide downside impacts, such as inflation and just shifts in the markets. How do you kind of make sure that you still stay rich? So those are kind of the things that I'm interested in. And one thing that helped me was really just going through self-realization. So who am I? What am I interested in? Just thinking about myself, I really liked the technology. Even when I was a kid, wanted to be an astronaut. But as I started to reflect on myself, I realized that I was more of a people person and not just the person that's sitting behind the scenes building the technology. So I really got excited, in the beginning of my career, doing project management, doing systems engineering, because you're working with different people and seeing all the components come together as one solution. And what really just drove me is what gets me excited, what do I really want to learn, and what's important to me. So I really realized that you can really do anything you want if you just come up with the steps toward it. And you can do your own research, talk to people that are in that position and see how you can get there. So if you want to become a venture capitalist tomorrow, you can get there. You just got to, establish the steps of how to get there. If you want to pivot from being an engineer to just working straight up in investment banking, you can do that. You just got to figure out a roadmap and a plan to get there and map out those steps to get there. Another framework is, when you wake up, are you excited? Are you happy with what you're doing? Yeah, I truly feel that if you're happy, you're successful. Are you at peace? Are you, not able to sleep at night? I think the biggest thing that people underwrite and underestimate is just, can you sleep well at night? There's a lot of people that are very successful, but they're tossing and turning every night because they're stressed out. And what are you good at and what excites you? Are you good at working with people? Are you good at just being behind the scenes, building the tech? A lot of those things kind of help in the framework of your self-realization. And what's most important, are you excited? Are you just taking a job to get a paycheck? And is it something that helps you pay your bills? But do you feel that there should be something more? And if there is something more and you feel that you need to do something more, what are you doing about it? Are you just going to be stagnant and just kind of sit there? Or are you going to do something to kind of find that exciting dream job? And are you getting paid well for the specific knowledge and level of difficulty of work that you do? Do you feel that the value that you get, do you feel that you're getting paid enough for the value that you offer? And is it time to change? Whether it's time to change doing something exciting, is it time to change, the amount of pay that you're getting, or just doing something that you're better at? If so, you can either settle for where you are, you can do something to transform that. And usually more realistically, if you do decide to transform, it's going to be more of a gradual roadmap. And how important is it to you, right? Is it aspirational where, hey, you know what, I've got a great career, I've got a great family, I love everything about myself, I'm healthy. I would really love to be a musician. Is it, how bad do you really want that? I think that's an important thing to keep in mind too. So I think, number one is realizing that you want change and realizing who you are. The second piece is, how important is that to you? Because if it's super important, then you'll make time for it. So, when it comes to successful reinvention, can you measure it? What helps is writing your goals down. So if you think about Jim Carrey, he wrote himself a check for $10 million. And 10 years later, he did make $10 million from the movie Dumb and Dumber. So writing down your goals really helps. And this is my career. I didn't really plan this out. I just really made changes and pivots based on my curiosity and my interests, right? So started out as an electrical engineer, put my foot down with, put a stake in the ground, focusing on deep tech. So, built a technical career in aviation, got my PhD in modeling and simulation. And with that, I was working with digital media. So that media experience and working with developers, designers, that helped me find a pivot into product management. So product management is kind of like a systems engineer, kind of like a project manager, but you're working with different stakeholders. You're really the CEO of the product. And I did that in the fintech industry. I realized that fintech was the highest paying sector in product management. So if you're building apps or websites, doing it for financial services does pay top dollar. And then that's, that knowledge in finance and tech really helped me to now pivot into venture capital and private equity, which wasn't easy, but I built the skills and the equity and the knowledge to finally make that pivot. And now what I've done is I've kind of built an ecosystem around me to empower other people to break into venture capital and private equity. So that's kind of where I'm at now, kind of building the community and the ecosystem around venture and education and community building. Couple things that differ between private equity and VC is VC is mostly early stage. You're going to be solving the world's biggest problems. Hopefully, you're going to be supporting founders who are being entrepreneurial. There's much more higher upside in the billions if you find unicorns, but there's also higher risk. This could unlock liquidity in secondary markets. So you're investing now. You may not see your money 7 and 10 years from now, but you could possibly get some secondaries if some of the companies sell earlier. Private equity, you're adding resources and capital to increase value. Sometimes you have to delist a public company and take it private. There's a subject matter expertise to the technology and the business where you're solving problems. So maybe you have a manufacturing background, so you come in and know how to turn around a company in the manufacturing space. You come in, you hire a new CEO. Maybe that CEO was the CEO of Whole Foods, and he's coming in. He really understands supply chain. So you're able to take a undervalued business that's maybe not doing that well, and replace the management and really add a lot of value, and then sell that company hopefully for a 2 to 3x multiple and get some large financial upside. And private equity is usually leveraged with debt. So debt is it comes in different flavors. So senior debt is kind of the more institutional capital that's coming in. That institutional capital usually gets paid first. So there could be a hybrid with debt and equity. So debt obviously means I'm going to give you $1 million and you just give me a 3% interest. So that's a debt vehicle. Equity means I'm going to give you $1 million and I get ownership of the company. So I get 20% of the company for $1 million. And then private equity and VC, the easiest way to look at this, people start businesses. They could be small companies. There could be companies that are a little more mature, and then a couple things happen after that, right? They either get an IPO or they get purchased by somebody else. There's a strategic acquirer. So this could happen in the early stage, which is the private companies, or it could be in the later stage where you're thinking about private equity. So private equity is much more in the later stage. Couple traits of being a good PE or VC investor: emotional intelligence, understanding technology, understanding finance, and really learning how to build relationships with people, because that's how you find the amazing deals, from your connectivity to the community. And a couple of ways to pivot into private equity and VC. You can be an operator that worked in tech for a long time, then maybe got into consulting, and then you get into a VC fund that maybe likes the background that you had. Maybe it's a mobility venture fund, and they really like that you had a lot of industry experience in the automotive space. You could also get into VC by creating a lot of amazing content and community. One of my favorite VCs is Mac the VC. So Mac the VC pretty much raised his capital on Twitter. And you can kind of follow him on Twitter. He's just really well known, has a lot of followers, but he talks about his story, and he just has a lot of great content that he puts out. But he's built a really huge community on social media. Obviously, there's a lot of regulation that you got to think about when you're raising money socially, publicly. So the structure that he has allows him to do that. And then VCs will come to you and recruit you based on the great content that you have. So that's a great thing that you can do. There's a guy named Andrew Karima. He created his own YouTube channel where he interviews a lot of really interesting people in the deep tech space. There are a couple elitist channels that you can go through. If you go to a top B school, a lot of times, you go to prep school, then you go to Harvard Business School, that you can get recruited out of there. The challenge is there's only a few roles in VC, and everyone from Harvard is applying to the same role. So it's tough to really segment yourself out of there unless you do something different. You could come out post MBA where you worked in banking or consulting, or you worked at Facebook, then you went to Harvard, and then you got recruited into an associate role. The problem with an MBA is after the MBA, you still don't have any work experience, so you want to try to get some hands-on experience somewhere. You could be a hustler where you go out on, you go on LinkedIn, cold message people, try to build relationships with people. You act like a VC, you join a scout program, you find interesting startups, you write interesting memos on why we should invest in a startup. You could also start a syndicate. So you can go on AngelList and start a syndicate if you have friends that are willing to back you. You can find a startup and then get some angel investors to invest in your syndicate. You could be a part-time VC where you work full-time at a company, and you have you work for free at a fund in exchange for hopefully some equity in some of the company or the fund. And you can write some really great memos as well. So this is a great website. Bessemer Venture Partners, they actually shared all of the memos of all the companies that they've invested in. So this is a good thing to review as well. If you want to learn what a memo is pretty much a write-up on a startup, and it pretty much goes through why you should invest in the company. So a couple of things that you want to think about is the team. How great is the team? How big is the total addressable market? And then how much traction do you have? So those are a couple of things to think about. And then if you want to learn more about our community, you can go to suttoncapital.co. This kind of goes through our content and community. Many people have been able to go through our program and break into VC. We also have a YouTube channel. So on our YouTube channel, we have a lot of guest speakers that come in from different backgrounds. So, hopefully that's also helpful for you too, but we have a lot of VCs that come in. Let me see here. We also have a Slack channel. So if you go here, we have a community of about 20, I think over 20,000 people. And like these people work in venture capital, they work in private equity. There's also a lot of people in technology and academics as well. So it's also been a great way to get a hold of people. And then we've got some additional links if it's helpful to kind of review. So Dr. Maurice has that. And I've also posted some blogs if you want to learn about venture capital. We also have a blog as well, and a podcast. So hopefully that helps. And then I would say as next steps, think about what is exciting to you, think about what your goals are, and understand your strengths and weaknesses, and come out with some type of plan to get closer and closer towards that. What also helps is when you connect with people, a power move is to ask people for advice versus ask them for money or a job or funding. So it is received a little more well. I would say it's perceived a bit better if someone approaches you for advice or feedback on something versus just kind of going directly to the transaction. So those are some things that I would say kind of entail my career and my journey and some things that I've learned, but happy to take this anywhere you guys want. One thing that we can also do is kind of talk about entrepreneurship and things that I've learned as well. But what questions you guys have? Hopefully that was helpful.
Yeah, so interesting, great presentation, by the way, but I had a few questions. So explain delisting a company. What did you mean by delisting, and why is that important?
Yeah, so a lot of times, there's companies that are public and, maybe the health of the company is not doing well. Sometimes there could be a hostile takeover where you're just taking over the company, and you may want to just take that company off of the exchange and make it a private company. So I'm actually reading a book by Michael Dell, and that actually happened with Dell. I'm still going through the early stages of the company, but I think they took the company private, and there's just a lot of reasons why that happens, and there's a lot of different dynamics, but there could be just strategic reasons why. There could be a hostile takeover where they want to just make the company more private, so you don't have to go through all the bells and loops that you have to follow if it's a public company.
Okay, because you talked about that, and then you talk about SME, or subject matter expert replacement. So when you do a SME replacement, is that done because that skill set is not within that current organization?
Yeah,
or you want to bring in your own person?
It might be both, and it might also be just because that you don't have the right CEO. If you think about Steve Jobs, in the beginning, he got replaced by the Pepsi CEO, and they thought that was going to make the company become a really huge success. But the DNA of the company was really innovation and Steve Jobs. So, just replacing Steve Jobs did not fix the problem. So a lot of times that works and a lot of times it doesn't, but you really have to come in and make sure you have the right team to get that company to either profitability or turn the company around. And if you don't, what's the problem is that there's a lot of VCs that have put in a lot of money at stake to hope that the company does well. And if the company doesn't do well, a lot of people are going to lose money. So it's in the vested interest to, make the company successful.
So what happens? You replace a CEO with another CEO, and you realize that the company really thrived better underneath that previous CEO. Are you able to go back and get this person? Has that happened before?
Yeah. I mean, that happened with Steve Jobs. And then if you think about WeWork, they ousted the CEO, gave him a payout, and they have a new CEO. That CEO has a lot of experience in real estate. And I think from what I've heard that the WeWork is on path to kind of actually get to profitability at some point in the future. But yeah, they had to get rid of the CEO, at Uber. They had to get rid of the CEO at WeWork, and they had to replace him with more seasoned CEOs that have kind of been successful. So a lot of times you have to replace the management team because the company is just not where it should be, and they have board decisions as well. So the VCs that have the larger amount of ownership in the company are going to have decision-making and skills and voting rights to be able to make decisions for the future of the company.
You were talking about, this is the section on private equity. So you're talking about how do you make money? You were talking about risk versus reward. So how do you make money? Because you said sometimes it could take 10 years, and that seems very long, right? So is that like something you can just put in, you make an investment in an organization, and then within a year, 2 years, it seems like it's a long run to get some return.
Yeah, I mean, I'll give you an example, right? So if you invested $25,000 in Uber and you waited 10 years, that $25,000 would have been 125 million. So although it's long, there's outsized returns, and that's why people put money into venture capital. If you want short-term gains, what people do sometimes is do late-stage investing, where they invest in Uber maybe 3 years before Uber IPOs. And then if you get that, you probably get a 3x multiple, right? Maybe you put in like a couple million and then you make, 6 million, but, so it's less time, but the multiple is less. So, and there's also less risk, but there's also less outsized returns because you're taking less risk, right? So that's the dynamic of early and late. And that's why we do early and late stage, because we do some deals that are a couple of years away, and then we do some deals that are 7 years from now, because we hope that there's outsized returns.
Okay. And then, so when you pivot into private equity or venture capitalism, you show a slide, MBA, elite MBA, but yourself, you have a PhD, right? So MBA or PhD, what would you recommend, or neither?
I mean, it really depends on the role. Some venture funds, like deep tech venture funds, these are funds that invest in quantum computing, they invest in, space travel. They actually carry a lot of weight on, they put a lot of weight on the PhD, because to understand these technologies, you got to go really deep, sometimes work with the academics. So if you join like a deep tech venture fund, and that's what I did, I actually was in deep tech for a long time. The PhD carries weight, but at the end of the day, right, I truly believe you can do anything you want in life. If you want to go off and be a VC, you can. I think the most important skill is sales. So can you convince somebody to give you a chance? No matter how brilliant you are, no matter how great of a school you went to, if you cannot do the simple thing of convince someone of why you're the best candidate, you're just someone that has another degree on your wall saying, hey, I went to Harvard, then I picked up this degree from Wharton. But somebody else who just was a little sharper, more enthusiastic, was more exciting to be with, maybe they're a better candidate for the culture of the company. So I truly believe, like, if you can sell yourself and help someone understand why you're the best candidate, you can smoke someone that has an MBA, a PhD, maybe even 2 years of VC experience, because someone may just be so excited about your story that maybe they want to give you a chance, you know?
So that brings me to my next question. So it's starting out as a VC for a company. What are like the starting salaries?
It depends on the company and the role. I mean, and don't quote me on this, but I would say it's very similar to possibly like a consultant. I mean, you could probably look it up if if you're like an analyst. I mean, I'm just looking it up here so I don't get, quoted here, but analyst, VC analyst, salary, and it also depends on where you live, right? But the average salary you're looking at as an analyst coming in is probably around like 70 to probably 90K. That's kind of what it's saying on the internet here. But again, I would take it with a grain of salt with the location and the firm. Bigger firms are obviously going to have bigger capacity. They're going to have a larger capacity to pay you more. But I would say definitely analyst is getting closer to like 6 figures, and then probably associate would be the next level, after that, which is probably like early to mid-career professional in venture capital. And then the principal is like the more senior person. So, I've seen, anywhere from 200K to 350K base, depending on the role. And then, partner is like the highest, but, definitely do some research and look up, I defer to what the job numbers are on the internet.
So as this is an IT entrepreneurship class, so how does one attract a VC? Like, you have an idea. So how does one actually get the attention of a VC to get them motivated enough to pour money into your organization or to your idea?
Yeah, there's a couple different KPIs. One of the biggest things is the market size. So
and what is KPI?
Key performance indicators.
Okay.
So those are some parameters that you look at as a VC. So there's quantitative and there's qualitative. So qualitative are just things that you just can't really measure. There's just something about this founder that makes them different. Maybe they have a vision that sees farther than everybody else. This person is super innovative. This person is already thinking about technology 5 to 10 years out. And what else about the CEO is special? And then what else is special about the team? So there's really some things that are qualitative about how they handle your questions. When you ask them a question, do they give you 5 different answers, or do they clearly and succinctly answer your question? When you ask them a question now and then you ask them a question 3 weeks from now, do they give you the same answer, or has the answer changed? So there's some just personality traits and red flags that you can pick up just based on people's personality character and their integrity, and also from references from other people. So those are the qualitative things as far as the grit, the hustle, the ability for this person to take an idea and really turn it into a company. And then on the quantitative side, one of the biggest things you want to look at is how big the market size is. So if you're building a cybersecurity startup, if there's really only a few thousand people that can use your startup, so let's say you're building a cybersecurity company and it's only for grocery stores in Boston, that's a really small market size. So that's not going to there just isn't enough customers to make that a multi-billion-dollar company. But if this is a cybersecurity company where anybody in the world can track their loved ones in real time, that is a massive market size, right? So you want to have big markets where there's a high volume of customers that could use your product, and they're paying a lot of money frequently. So if you think about it, Uber, you always have to go somewhere, right? When you think about the food delivery apps, especially during the pandemic, people are even more lazy, and and there's safety issues. So that really grew that business to support people that were in a pandemic that needed food on demand. So just think about problems that will always happen. People are always going to get older. People are always going to get sick. People are always going to need elderly care. People are always going to need to pay their taxes, right? So I think about businesses where you just always have to do that workflow, right? Like we're not going to get to an age where we stop paying taxes. So, I think it's really interesting, those boring businesses that support tax strategies in a unique way that's not already done. I would say as well, this is not something that people want to talk about, but people will always die. And is the current process of how people have their funerals efficient, or is there an easier way to do it in a more cost-effective way? So to just think about, I think you want to start with the problem, but you also want to start with a problem where there's a big enough sample size where it'll generate a lot of revenue. Hope that was helpful.
Yeah, that was very helpful. Now I need to now I need to start a business.
And then a couple other things, right? So that's the market size. The other thing is the team, right? Do you have the rock star team to achieve and execute all those goals? And then you want to look at revenue, so if you're in the early stages, there's pre-seed. That means the company is really just an idea, but it's a rock star team. And, maybe these people came out of Google and they've already sold their company. So they already know how to launch a business. So because of those team members, you're going to back them. But you also want to see teams that already have some traction. Maybe there's a team that already has, 15 to 20K of monthly recurring revenue every month. And then you see them growing the revenue every month. So they're essentially a money box, right? If you give them some money, they're going to reinvest that money into the company. They're going to grow and scale the business to generate more and more revenue. The more revenue that they have, the more value, the valuation of the company is going to get higher. And that's going to be more attractive to raise more money to get to maybe their Series A. And then they get to their Series A, the capital that they get, they put more money into the company, generate more revenue, and then the company has a higher valuation.
So what's a Series A? So Series A is just evaluation of the company?
So there's this, the series is the stage of the financing. So, when you're at early stage idea, you're like pre-seed. That means you are super early. You have maybe a website, maybe a rough prototype, and then you get to seed. A lot of times seed means that you have a working prototype, you have some revenue. That's also the transition point when you get into an accelerator. So if you get into one of these startup accelerators, a lot of times they take people into seed. And then Series A is really when you hit, more than $1 million in revenue yearly, right? So you've hit some serious revenue growth and you really have a repeatable model. That's really when you hit product market fit. So Series A is a larger round of funding. Usually it's probably around anywhere from 3 to 10 million in funding. And that's when you've really hit product market fit.
Is that the time to seek a VC when you have, when you've actually started hitting that type of numbers, or do you want to hit a VC before?
Mm-hmm. Yeah, you could hit a VC before. There's VCs that invest early. There's VCs that invest in pre-seed. There's also angel investors. These are high net worth individuals that work at IBM, so if you're accredited, that means you work at a tech company, or you have a combined income of 200K. Actually, to be accredited, you have to have earned 200K for 2 years in a row, or 300K as a married couple for 2 years in a row. If you meet those specifications, you're considered an accredited investor. So you can invest directly into startups as a high net worth investor. So you can seek capital from those people. And most of those people these days in the tech ecosystem, most of these tech companies pay pretty well. So, if you're getting a job at Google, most of these companies' base salary is in the tech space is probably anywhere from, 250 to 300K. So those people have the capacity to maybe make a few investments a year as angel investors. So that could be a great.
What is your recommendation as angel investor? What is do you think it's worthwhile or what?
Yeah, I mean, it's, startup investing is risky. So if you believe in a startup and you really think that they're going to take off, you should do your own due diligence and do your own research. So what I would recommend is you can also, if you want to go at a really small scale, you can go to, and, please do your own research. This is not financial advice. So please speak your own, talk to your attorney, but there's a couple interesting websites that you can browse to see startups, right? So you can do your own research and understand, which startups there are. So like a company like WeFunder, you can get in at a small scale and they have a lot of interesting startups. And a lot of these companies actually have a lot of the research written about the company as well. So the details are in here, the overview. So they actually have a whole paper written about the company. So you can just research these companies, see if they're worth it. Now whether it is worth it, that's really a decision that you have to make in terms of your level of risk and your investment strategy. Some people just want to invest in real estate. So I'm not here to prescribe any financial recommendations, or advice, but I would do research on startups and see if investing in startups makes sense for you, within your level of risk, and just figure out what you feel comfortable with. There's people that are investing in crypto. If you want to look at NFTs, you can go to, some of these NFT marketplaces, like OpenSea is one of them. So if you go to OpenSea, if you like NFTs, you can check out OpenSea. They have all these NFTs on sale. So that's another option. But yeah, if you want to get into startup investing, maybe hang out with startups and go to events and learn more about the industry and learn about, some of the main KPIs that make a startup successful. And I think some of them are really, like I said, the team, the technology, the market size, how much revenue do they have, the business model. Those are all things to look at. But, you can browse around. WeFunder is a good one. Seed Invest is another one where there's just like smaller startups that are crowdfunding startups you can research. Another one is Republic. So, do your own research. Again, this is not a financial advice, but just take a look at, some startups. If you think are interesting, do some research on them. This is kind of cool, bike parking. So bike parking, how many customers could possibly use this? How many spots do you think there are in the world? And then, if they're launching in San Francisco, how many are there? So you want to look at the traction. Maybe they've taken over massive distribution of all the bike pods, right? So you want to think about what's special about this company. What is this company doing that nobody else is doing?
So you really have to do your homework, and so it's not just looking like there's lots of stuff. I know there's lots of I can't remember the actual platform, but there was an open source gaming console platform that got funded, but it ultimately failed like a few years later.
Yeah, I mean, most companies fail, so that's a risk, right? If you ever watch Shark Tank, I mean, some of those companies are hit or miss, right? Some of them are great, and then some of them are still pretty early, and they didn't get the investment. So
yeah. So what happens when if one invests and then the company flopped, then it's pretty much investment lost, right?
It is, yeah. I mean, so venture, it's you're going to invest in a portfolio of companies, and some of them are going to do well, some of them are going to fail. So that's just your portfolio construction. So that's how venture is. I mean, it's the same thing with stocks, right? You could buy a bunch of Amazon, you could buy a bunch of Amazon or Microsoft stocks, and then the stock market might crash. So it might be a loss if you didn't, follow a strategy that made sense. So there's always pros and cons, right? I mean, you can also put your money in your 401k and kind of let it sit there, which is great, but there's less risk, so there's less returns, I would say.
All right, I think that's all the questions I have. Maybe some of the students may have questions.
Sure. Yeah, what questions you guys have?
Yes, I have one. Let's say, what is the ratio of successful to unsuccessful investments? So let's say, out of 10 investments, how many of them succeed?
Yeah, I mean, I don't have those stats offhand. That may be something that we can maybe offline pull some data. But in general, right? I mean, 9 out of 10 startups fail. So like, that's kind of the rule of thumb. I mean, most startups do fail. right? So it's a very high risk asset. But if you get one Uber, that could
Yeah.
return your entire fund, so that's kind of the upside that you're betting on. So you want to, do educated research on different companies, understand their business model, and you have a vested interest to make them successful as well. So you want to help them, grow and get all the resources they need, because if you help them, they'll actually continue to grow and have hopefully a big IPO. But yeah, I mean, general rule of thumb is like anywhere from 85 to 90% of companies fail. But there's probably some more statistics coming from data sources on like specific numbers of like the actual data points. So we can do that. We can pull that offline if it's helpful.
Yeah, and I have other question. So
Mhm.
you say that you start like getting the revenue, the profits, like 7 to 10 years later. So these years, like, how do you get money? Like venture capital fund,
Yeah.
where do they get the money? So to do a living for,
So venture capitalists, they have money to invest in startups, and then they charge a 2% fee. So if you have $100 million fund, you can charge a 2% fee out of the $100 million.
A year.
Yeah, 2% a year.
So the startups have to pay to you.
Startups don't pay anything. You get money from institutions. So, if you're a $10 million venture fund, you get that $10 million from high net worth individuals and institutionals investors that are looking to get into venture. You're giving money to the startups. The startups, right? So they don't have any money. So you're investing in the startups early, so the startups will be successful maybe 10 years from now.
Yeah, but this 2% of fee, who pays for you?
So you're going to get $10 million. Let's just say you have a $10 million venture fund, right?
Yeah.
The $10 million comes from an institutional investor. So maybe a large insurance company, a pension fund, it could be a family office, it could be a high net worth individual. So there's wealthy or institutional investors that will give you the money. You have to raise money, just like a startup. So if you're a venture fund, you have to get capital from institutions.
Okay. I thought that
Yeah.
it was your capital.
Well, yeah, I mean, you have to get that capital from somewhere, right? So sometimes what happens is like somebody comes into wealth, right? They sell a company, they started a company maybe 10 years ago, the company sold for 50 million. So then they take some of their capital and put it into a fund. But a lot of times wealthy people don't want to use their own money, so they may, there's a lot of people that have sold their company for 30 million. So they have $30 million, right? And they don't want to spend their whole $30 million. Maybe they put maybe 1 million in, and then they raise money outside from other investors.
Yeah, so they
and
act as intermediaries.
They're not intermediaries, they're managing money. So they're money managers managing capital and then deploying that capital into startups. And then hopefully the hope is that these startups, when you invest in them early, 5 to 10 years later, those startups are multi-billion-dollar unicorns. So that's kind of the goal.
Okay, thank you.
Yeah.
It seems like it's really difficult to find those unicorns.
It is. I mean, it depends on relationship building again, right? So if you're connected to these other VCs that have access, then, the hope is that you get access too. But yeah, it's not easy. There's sharp elbows, different VCs are fighting over these deals. So, you have to really be good at relationship building to get access to those deals. So.
All right, anybody else?
Cool.
All right, I think we are good.
Great.
Joel?
Yeah, and this is my email. If you guys, I'll just give you guys my email if I can help in any way. It's just joel@suttoncapital.co. There you go.
All right, and Joe, I will post this video on my YouTube page.
Great.
And share it within the entire department. So I will actually stop the recording now.
Great.